So it looks like everyone is on board. Again, warm welcome to the first 6-month earnings report of 2025. Warm welcome from Ines and myself. We're going to go through the presentation together today as last time. And before we start the presentation, we have to read or at least hint you to our legal disclaimer that all the content we are giving today are based on views and assumptions made by the management using information available at this point in time. So these are also forward-looking statements by nature, and they are subject to significant known and unknowns and risks and uncertainties. Yeah, the presentation today, and we are happy to present you a good momentum, a positive momentum. We will start with an executive summary. So I will sum the situation up. Ines then will dig deeper into the financials, giving you a quick glance at our share development, and then I take over again for the outlook. And hopefully we have at the end of the call a lively Q&A session, and we are happy to answer all your questions. Starting with the executive summary and with the market environment we have seen in the first half year 2025. To put it in a nutshell, the market situation was still not stellar, even though it was a bit better than the industry expected it. For the German industry that exports worldwide, bookings were down by -4%, and billings were up by 9%. So what you can see is billings high single digit, so that was better than expected. But in the, let's say, last months of the first half year, the booking situation went down, so that we see bookings much weaker than billings, and that there is at the moment not a significant positive momentum in the industry, but we come to our situation later. If we look a bit deeper, especially all verticals, despite semicon, advanced nodes, and everything that is artificial intelligence related, and also besides logistics and warehouse automation, all markets and verticals seem to be quite down. Also, when you look at the industrial PMIs in the advanced nations that we sell to, where high-tech machinery is being developed and produced, these PMIs are around 50, sometimes a bit lower, sometimes a bit higher, but in general still a relatively slow situation from a market perspective. There was also one significant flop, or especially in the EV battery. There were high hopes in the whole industry that capacities will be built up in electric vehicle battery production. The yield is pretty low, so you need a lot of yield management, which also means a lot of vision technology can help. And these high hopes are dashed due to the slow demand and falling demand of EV battery, overcapacity, changes in policy also that lead at the moment to the situation that many of those projects are stopped or even cancelled. What is a much better situation than the years before are the inventory levels at clients. They reached normal levels, so we really see the demand. There is no muting effect due to high inventory levels at client side. From the competition situation, I mean, with the especially Chinese and Asian competition in China and Asia Pacific, and these slow market situation, the intensity was pretty high the first half year in 2025. And we talked a lot about it in the last call. The newspaper is still full of it. The unclear US tariff situation and geopolitical uncertainties hold back CapEx decisions, and this means for our clients that their business is unsecure and also muted, because 99% of our clients are CapEx machine or CapEx device makers that integrate our vision technology into their machines or devices. What came on top in the second quarter of this year was especially a significant FX headwind due to the depreciation of or devaluation of US dollar, Chinese yuan, Japanese yen, and Korean won against the euro. And we will talk later about that. This definitely had quite an impact at our P&L as well. Yeah, how have we done in this market environment? And also here in a nutshell, we outperformed the market by far. Bookings up 22%, billings up 20%. As explained in our last call for the Q1, we participated or benefited from larger orders in the fourth quarter that we carried over and built in the first quarter and shipped. But the good momentum in order entry continued. I mean, the sound order entry in the first months of the year, and actually in the later months of this first half year, we also had increasing bookings that at the end led to a situation that the second quarter in billings and book-to-bill ratio is significantly above 1, which also gives us a good momentum for the third quarter. Strongest regions in the whole first half year, US and China outperforming significantly the rest of Asia and also the European market. The gross profit margin improved by 0.7 percentage points to 47.2. However, we had quite some negative effects, especially in the second quarter due to FX. Yeah, we lowered our break-even point already with all the initiatives last year in the cost-saving programs, and went into the year with the break-even point of 180 million. However, due to the change in FX, this break-even point is at the moment more in the range of 190 million euro. But all in all, we are pleased to give also not only the revenue and bookings growth here, but also to report that we are back in the black numbers with a pre-tax result of almost 8 million and an EBT margin of 7%. Looking at the team structure and size, I mean, due to the cost-saving programs compared to mid of last year, we more or less reduced by 60 FTEs over the course of the last 12 months. The distribution have not changed much. There are slight deviations, but we also have some allocation changes here from a function perspective. So more or less you can say distribution is kept stable, but we are 60 people less, of 60 FTEs less on board compared to the mid of last year. The increase in sales and the reduction in staff have caused a situation where we are back in the R&D quotas, where by and large we want to be around 13%, coming from a relatively high number of 15.5. So also 13% is high. We are, let's say, still on the gas pedal regarding investments into new products. We don't have a specific or launch specific new products in the second quarter, but in all these areas, mainstream product systems, performance product systems, 3D technologies, and also a new on board, also the line scan systems. We all invested in that, and especially also invested further heavily in our Pylon software development kit, where all our products are based on, and this is the design kit or this development kit for our clients, with which the client can combine all the hardware he gets from us and also connects our hardware and integrates our hardware into the specific system or device. To give you some highlights what we have done, I mean, we were on multiple exhibition shows over the course of the first half year. One of the recent shows was the Automatica in Munich, one of the big automation shows of the world. We're presenting here technologies, vision technologies all around robot guidance, and also certain in logistics, and also in the production space. So we position ourselves here as a solution provider, so combining different components into a solution for example, robot guidance. Another interesting topic we brought with us today is from our innovation department. In our innovation department, we are at the moment working on new concepts, how our clients can virtually test our products, because typically our clients test hardware before or during their development project. This is quite a heavy effort, and it's also takes some time to get hardware, to install hardware, test it, and then maybe change it again. So we are working on virtualizing this based on NVIDIA Omniverse space, and we were also on NVIDIA's global tech conference in Paris, demonstrating this, and you see some pictures how this looks like. Below in the picture you see a virtual scenery. So actually all our products become virtualized. The customer is setting up the scenery, and then the customer can virtually exchange and test different products in the virtual space, and then acquire all the hardware that is a good fit. So this is definitely time saving for the client. This is all pretty new stuff, but we want to also showcase some of the topics we do for the longer run. Yeah, all these pays in our strategy to move step by step from a camera company in the factory automation space to really become one of the largest full range provider in the computer vision space, addressing multiple vertical markets and offering multiple components, and also combine those components to a pre-configured or bundled solution. Yeah, I hope this has given you some glance from the executive standpoint, and I will continue and hand over to Ines for the financials.
Thank you, Hardy, and happy to present the financials to you. So here on the first page, we are continuing that view where you can see the sales distribution by region. I think following up on the second page that we presented to you, right? So you see the trend of an increase in Americas and Asia. Yeah, so this is in the distribution driven by the major projects, and also really the strong development that we are seeing in these two regions. So jumping to my favorite picture so far, I would say, here's the bookings and the billings. You might recall that in the last quarter we indicated that our bookings of the 52.1 might be indicative of the revenue that we are expecting in Q2. Now looking at the outcome, we think it was really indicative. So now taking a look at the picture we had for Q2 is really that 61.2 in the bookings, yeah, so which is a momentum of 26% above what we really had last year. So the 22% you saw on the first page was for the first half year in comparison. At this time we have to say the 61 we don't hold really indicative for the next quarter, but we are definitely pretty pleased on the performance of the bookings. This is again driven also by larger projects in China and Americas, which will help us in the usually weaker quarter of Q3. Yeah? So holding against weaker bookings, but also usually lower turns in the third quarter of the year. So overall, bookings and billings, good performance and according to our plan. So then jumping from the top line to the gross profit margin. I think this might be even more interesting. I like the EBIT picture even more or even better. What do we see here? So you see that in euros, of course, the gross margin declined and also our gross profit margin declined. So that has majorly three components this time. So we have about a 7 million decrease in comparison, or lower revenues in comparison to Q1. So we have a volume impact here. But on top of that volume impact, currently the currency effects are hurting us. So that started in the last months of Q1, but we didn't have a really big push in Q1. So we had a nearly 2 million effect from currency in Q2, which hurt us in the revenue, of course, but also had a push through to the gross profit. We have some natural hedges and hedges in place, but it's still not a full natural hedge in there due to our structure. And you also can see the impacts of the tariff. Since Q2, we are pushing the tariffs over to our customers. But we had a little bit of a delay in the push implementing the project. So we are currently for this Q2, we were running at a negative impact of around 400K. For the future, the push is in place. So we are basically plus minus zero here in the effect, but we have to keep in mind that pushing that tariff has a positive impact, so to speak, to the revenue, but a zero impact of the gross margin and the EBIT, also having a negative percentage, to the gross margin in percent and the EBIT in percent. So same picture here. I think also last time here we were already indicating that the 10.1% of Q1 was a very good performance of that quarter, driven by the volume and not so much impacted by the FX. So what you can see here is really the push through mainly from the gross margin. So we are losing from the volume. This is the one angle, but also you have the push through in the effect from the X rate and also from the tariff in here. So this mainly explains what you're seeing. We are running good on our operative costs. So a little bit of a positive upside in here, but of course the picture looks way lower than Q1 due to the volume and those two effects. It's not really surprising to us, but it's of course lower than Q1. So for us, it's continuing our driving the top line and taking care of our cost position that we have. Here you have the usual overview. This is H1 this year against H2. I think you heard us talking about it now. So you see the positive ratio of order entry against sales. You see the increase in the gross margin overall. So we have 47.2. We wanted to be at nearly 50, and we did calculations of what would have happened if we wouldn't have had the exchange rate impacts. And we think we would have been close, a little bit under 50, so pass is there. And of course, we want to highlight the EBITDA, because our EBT is impacted by a lot of depreciation currently, so no cash flow impact in here. And the EBT margin of now 7%, which is trending into the right direction from our point of view. So then jumping from the bottom line of the P&L to the free cash flow picture. So here, different picture, at least from the OCF for Q2. So what do we see here and where do we get help from? So of course, we had a positive period result, but we are also having a lot of help from the working capital. So we are collecting our receivables Our inventory drives down according to plan. We had a little increase in the liabilities from our suppliers, but that was initiated. So overall, good performance on the OCF. The ICF is also according to plan. And the free cash flow, you might recognize that OCF and ICF here are not adding up to the free cash flow picture because you see that in the tables that we are also issuing. So here's a 500K-ish missing from an exchange rate impact that we have to show separately. But these are the major impacts, and the cash impact on the cash accounts is not displayed here, but going into the free cash flow. So that drives us to this picture, which displays again the free cash flow and our cash positions, and also the cash at the end of the period. Here you also have the cash flow from financing. So we are returning our debt positions and reducing the debt positions accordingly. So this is how, despite the positive cash flows, you see the cash going down. Positively impacted, of course, by the performance and overall in the direction where we currently want to see it. So overall picture, cash by the end of the period, nearly 19 million, and liabilities to banks being down to a little bit below 50 million. Yeah, strike. Strike completed. Okay, jumping now, sorry for that, to our shareholder structure. I think we are going to show the picture again, right? So no major changes in here, with Norbert Basler holding again at the 53% and our free float at 28%. So really no major deviations to last time. But major deviation to last time when we showed the picture of our share performance, which is quite positive. I think today we closed the 13 euros, but we were coming from 6.09 at the beginning of the year, and we closed the quarter with 12.32. And we bet the index, by the way, yeah? So which is depicted here as well.
Okay, this brings us already to the outlook. I guess one of the most interesting parts of the presentation also for you. And talking a bit about the environment we expect for the second half year and about the specific topic of US imports. I mean, things are volatile, as we all know, they can change every day. But we want to bring across again our philosophy that there are certain things that we are able to influence. On the left-hand side here, to bring you up to speed, we roughly deliver from the German factories into and export into the US roughly a value of 30 million euro on an annual base. Certainly this is depending on product mix and also local demand. And then our US entity is selling this to our client. And on these transfer prices, obviously, we are paying tariffs. So we, as Ines mentioned, we have installed a system that is passing through the tariffs, exactly the tariffs that we are more or less exactly what we are paying. So we don't earn money on it, but we do it in a very transparent way. And our clients, and thanks to our clients on that side here, are willing to take it. And we also believe now with the increase in tariffs from 10 to 15%, as it looks like at the moment, our clients will behave the same way. So the impact on our side is limited. However, during Q2, as we have had a time delay in implementing this in our systems end-to-end worldwide, we lost some money on the way. This is approximately 500K, a little bit less actually than in Q2, but maybe when we have to shift to the other tariffs, there will be always a small delay. But in general, we can pass it through and we think the impact will be limited. But there are also aspects in the second half of the year that are not under control, not under full control at least. The one element is the demand itself, and when we looked in the beginning of the call into the picture of the European industry with a negative bookings trend, so there might be a slowdown in the market, even though we see a good momentum in our books outperforming the market, and definitely we are also facing strong headwinds regarding US dollar and Asian currencies that cost us quite some gross profit, a couple of percent points actually. So what as an environment do we expect overall? So we believe in line with trade associations that the market that has grown in the first half year might on an annual base be more making a sideways move. We also do not expect in the current macroeconomic situation that the purchase manager indices will change a lot. So they, to our perspective, most likely will wobble around the 50. Trade and geopolitical conflicts continue, and this will mute further the investment climate, as mentioned also when we look back into the first half of the year. We expect also in our assumptions now that currencies stay that weak, so on the US dollar side and Korea and Asian currencies. If this will change dramatically, then also this will be a benefit to us. But at the moment, we calculate with these weak foreign currencies against the euro. We also assume that the intensity of competition will stay or even rise, because in this market situation where there's just limited number of projects, everyone is fighting about these projects. We also have good indication that larger project business in the logistics and also semicon AI related applications in China and in the US will give us additional opportunities, most likely in the second half of the year. I mean, we need to win those projects, but at least we see signs that they will be there. And all in all, please bear with us. The visibility and predictability is very low at the moment. Customers order very last minute. We have typically 2 to 3 weeks delivery time. This means for us, we have visibility of 1 or 2 months max into the future. So for us, this is flying, not flying blind, but flying in a foggy landscape. And taking all this together, looking at the first half year performance, looking at the good order momentum end of Q2, and also considering this more difficult market landscape or continuing difficult market landscape, we are convinced that we can be better than our original guidance, and therefore we increase our guidance for the full year from revenue in the corridor of 202 million to 250 million. Formerly, we guided 186 to 198, so substantial increase. And on the earnings margin, we formerly guided 0 to 5. We go up from 2 to 6. This might be a little bit less than you would have expected with such a revenue, but this is mainly driven by or maybe mainly caused by the headwinds of FX. This forecast for 2025 gives us good momentum and also makes us confident with our midterm plan to grow, to get the company back to a 15% compound annual growth rate by and large, get it back to a sound profitability of at least 12% earnings margins, and realize by and large 275 million in 2028 with a strong cash conversion rate of 70%. Here also, the assumptions have not changed. We need next year a better market environment, even though this year we are most likely really able to outperform the market by far. We also, for this midterm plan, we need a better market landscape. We are now the third year in a row in a difficult market, so there is high hopes that at least next year the market will start to recover. And another aspect is we need to remain access to the China market. I mean, after our revenues went down a couple of years ago, we stabilized the revenue in China, and now China is even growing faster than other regions. So also here, this market needs to be an element in order to realize these goals.